First up, private equity is making massive inroads to financing the economic growth on the African continent. While this is not the biggest form of investment, the asset class has many roles to fulfill in the absence of large and liquid public markets. Here to give us a rundown of what's been happening in the space is Rory Ord, head of Riskiera Fundamentals. Rory, thanks so much for your time. Well, let's kick off with the hottest spot for private equity on the continent right now. Let's go straight to the geography.
Thanks. The most interesting place on the continent at the moment has to be West Africa. We're seeing far and away the most growth in activity there. If we look at absolute amounts, though, South Africa still leads the bunch. We're still seeing the most private equity transactions in South Africa, but I think West Africa is hot on our heels, particularly places like Nigeria, Ghana, and to a lesser extent the smaller economies in that region.
Rory, I just wanted to come in here, and obviously Nigeria has a stock exchange, a quite a well-developed stock exchange, but you noted in the research report that you sent us that there's an opportunity for private equity to get involved. Just tell us some of the transactions you're seeing in West Africa at this point, and where private equity is filling in for public companies.
Yeah, certainly there are stock exchanges in West Africa. The difficulty with African stock exchanges in general is that they lack liquidity to a large extent, and on many exchanges there are very few listed companies. The sector focus of the companies is also important. So on West African exchanges we see, Nigeria in particular, we see a domination from banking shares and various other financial stocks. So it's quite difficult for investors to get access through listed markets to things that are very important to the African growth story, such as consumer spending and things like industrials. So that's where private equity has really come in over the last few years, in that deals have become available off the listed markets, but in the sphere of private equity in these particular sectors.
In terms of other emerging markets, we're just out of the BRICS summit: Brazil, Russia, India, China, obviously South Africa. How do you compare emerging markets with the African story? Other emerging markets, let me rephrase that.
So for this purpose, it's quite useful to see the 54 countries of Africa combined to make sort of a large market, if you will, to view the continent as one, to enable us to compare it to other large areas of the world, such as the BRIC nations that you mentioned. And when you do push the whole continent together, we start to see a slightly clearer picture of Africa's place in the world, in that the African continent is slightly less, it's slightly larger than the two of the BRICS and slightly smaller than the other two. So China is easily the largest of the BRICS, followed by India, but Africa actually slots right into the middle, just before Russia and Brazil, if we regard Africa rather as one solid geographic area.
Rory, just to come in here and ask around some of the things that you're seeing in private equity. Obviously, a very well-known model in the developed markets is to take a public company private, and that usually involves quite a lot of debt. Just guide us here with some of the types of transactions that are taking place. Are there any situations on the continent that are unique to Africa as opposed to some of the deals being done in private equity around the world?
Yeah, that's a great question. The African private equity model is very different to what would be experienced in the US or in Europe. And if we separate out South Africa, which is somewhere in between. In South Africa, leading up to the financial crisis, we did see some of those large buyout transactions. We saw some delistings, which happened with significant amounts of debt as part of those transactions. We saw probably up to 4, 5, 6 times EBITDA used in debt in transactions, whereas after the financial crisis, we've definitely seen that fall away in South Africa. In the rest of the continent, we really haven't gotten to that place where there's a significant use of debt in transactions, and a lot of this is because of the poor availability of debt. Financial institutions aren't nearly as developed in Africa as they are in other parts of the world, so there isn't that constant availability of debt to fund transactions. And as a result, we see transactions being largely equity financed. which in a lot of ways is a good thing for African private equity because it keeps the risk at lower levels in many ways.
Who's leading the charge, Rory, Who's leading the charge when it comes to private equity on the continent? The big players, are they just a handful of them?
Yes, there are only a handful of sort of large players, but there are a number of smaller private equity and into venture capital, into the venture capital side of things, players in that kind of size. There are probably only around 10 private equity firms who operate at the top level, who do large buyout transactions of large and often multinational companies. Those are very few and far between. What we see much more of now is smaller private equity firms with smaller amounts of capital at their disposal, but they are quite well able to invest in the types of companies that are available for investment in Africa. So in Kenya, for example, we see a number of smaller players targeting more the SME space up to medium-sized or mid-cap companies, and similar things in West Africa. In North Africa, there are a number of large players and well-established private equity players who've been around for several years, who have managed institutional money and have really grown in size. So that would cover places like Egypt, Tunisia even, and Morocco. But in places like West Africa, there are only maybe one or two large players, and the rest operate in that small SME type of zone.
And Rory, what are the types of corporations we're talking about here? Obviously, if they're not listed, are we talking about family-run businesses, or are we talking about partnerships? What type of businesses are being bought, and what's the objective then? With these businesses, I imagine obviously quite a lot of incentive to try and grow them, and that's probably the reason why a family-run business, for instance, might take on a capital partner like a private equity firm.
Yeah, you're right. Most private equity transactions are about growth in Africa. In other parts of the world, they may be more about financial engineering. You brought up the point about debt. That's not really the case in Africa. It's largely about growth. So whether that's for a large company or a small one, the focus in almost every transaction that I've seen is around the growth of those particular enterprises. It's just the way that the growth happens, which is a little bit different. So it may be a family-owned enterprise that gets some private equity capital to help it to grow. Maybe that's to grow from being focused on a particular city to being a nationwide business, or a national business being taken regional. And even the very large transactions that we see are often about taking a proven concept that's achieved scale in a certain region and moving it wider than that, taking it to a larger scale.
I want to come back to the private equity sector focus on the continent and just drill down into that conversation. The consumer story is obviously an enormous one, specifically in West Africa, which you say is the hottest spot when it comes to private equity. Do you find that private equity is following the hot stories, infrastructure, consumer, telecommunications?
To a large extent, yes. And it comes back to the point you were asking earlier about access to these types of sectors. And yes, we're seeing almost half of private equity deals in Africa going into a combination of the consumer and the industrial sector, which is really the engine room from a consumer point of view and from an employment point of view as well. So that's another benefit that private equity brings, is actually employment in different markets.
Rory, just
the other sectors, the sub themes that we're seeing are some interest in things like healthcare and education, sort of the kind of sectors that traditionally have been the preserve of government investing, or in some cases multinationals. We're seeing those come through as sort of smaller trends within the subset of sectors. When it comes to infrastructure, infrastructure is slightly different in that it takes a lot more capital than a normal private equity deal. So there are only a smaller number of parties, a smaller number of private equity managers who can actually put together an infrastructure deal and participate in that. However, there's certainly more nowadays than there used to be.
Rory, just to come in here, we had we had John Oliphant on the show the other day, about a few months ago, and I think he's still upset with us because we haven't got it back on yet, Bronwyn. But we had him on, and he was talking about the role he sees for a funder like the Government Employee Pension Fund to fund private equity transactions on Africa. He thinks it's a great way not only to aid the development of the continent, but also to generate returns for his investors. And I wanted to get your opinion on how the attitudes are changing within South Africa and the institutional market towards using private equity, and specifically on the continent.
This is a really important area for the developments of the continent in general and the development of private equity on the continent. There needs to be institutional buy-in to the concept of investing in unlisted companies. Without that support, the levels of capital will remain low, and a lot of companies will go without potential funding. The GEPF has been very bold, and John Oliphant has driven that process in the process that they want to go through and the amount of money that they want to invest in the continent. And their vision has been very clear in the way that translates into economic growth through the continent, which will ultimately benefit South Africa. So they see themselves as investors in things like infrastructure, in key sectors throughout the continent, whether it be listed or unlisted. They want to make an impact with their money, as well as earn the returns for their members. And that's a fantastic approach. And what we're hoping to see certainly is that we'll see more institutions looking to go north of the South African border. For many institutions, though, it remains something that is perceived as very high risk, very unknown, and I think it'll take a little bit of time to get there.
Let's drill down into...
Institutions are taking some moves.
Rory, can you break down that risk for me a little further in terms of what is the key risk that players on the continent are still facing? Is it political risk? Is it corruption risk? What would you say is the overriding problem that players on the continent face?
My personal view is that the perception of risk on the continent is actually overblown. That the risk isn't as high as people think it is, and that what drives the risk perception is simply that concept of the unknown. And that what we've seen with investors from other parts of the world, from the US, around Europe and the East, is that as soon as they come to Africa, they visit different countries, they start to get a feel for what it's like on the ground. They see that there are people in cities, it's not a war zone, people buy goods and services, people carry on with their daily lives. They see that it's not that different. The one risk that I would like to highlight, though, is currency risk. It's quite an important one. In that many African currencies are quite volatile. So for an investor in a hard currency, there is certainly that risk. There are other risks. Certainly political risk is one, and we see the way that economies around Africa slow down around election times, which is really the way of those economies to take those kind of risks into account and not make any major decisions before elections. But those things are changing. They're all reducing, and the continent's becoming a much more stable place.
Rory, I just wanted to add another risk to that. And when I look at, looking at private equity on the continent, is there not an exit risk? Because of the lack of capital, once you've bought into a business, grown it with an entrepreneur, and you look to exit it as a private equity firm, because that's how you obviously realize your profits. Who's going to buy those businesses going forward? Do we not need, it's almost a self-fulfilling prophecy, the more private equity players we have on the continent, the easier it is to do business because they can buy and sell between each other? Or how do you sort of anticipate that risk in the context of the lack of liquidity and capital in African markets?
Yeah, this is a risk that's highlighted very often, and it's something that we've seen start to change over the last few years. There's so much more interest in Africa from all sides that the risk of exit is actually starting to diminish. So far and away, the biggest source of exits that we see is through what's called trade sales, or sales of companies to other corporates. So, for example, there are a number of South African firms who are looking to expand around the rest of the continent, and in a lot of in a lot of cases, they make a natural exit route for a private equity firm who's perhaps picked up a business earlier at its stage of development, has taken it, perhaps put proper controls, and has put it into a much more saleable condition. And then when the corporate comes looking for exposure to a particular market, there's a business that's ready for sale, that's actually been prepared and corporatized and ready for that trade sale. There's also the routes of listed markets, but most private equity practitioners will tell you that they don't rely on the vagaries of the listed markets to guarantee them an exit. What they focus on is trying to make a company attractive, make it profitable, and if it is attractive, there will always be a buyer.